Hello everybody, this is Toni Turner and welcome to the market now as of about 11 a.m. Eastern on Friday, April 7th. Well, U.S. stocks dipped in volatile trading this morning as a disappointing U.S. jobs report said that U.S. employers added about 98,000 jobs in March. That was the lowest in 10 months and well below economists' expectations of 180,000. Adding to the market's nervousness is a U.S. missile strike on Syria that took place late on Thursday last night on an airfield in Syria from which a deadly chemical attack was launched earlier this week. That news of the attack helped to send global markets lower, with the S&P 500 futures index falling as much as 0.5% at the open this morning. Still, many losses recovered after U.S. officials described the attack as a one-off that would not lead to wider escalation. And on that news, let's go in and look at some charts that could help us get some insight into the week to come. First of all, we'll look at our daily chart of the S&P 500 SPDR, symbol SPY, the exchange-traded fund that closely tracks our S&P 500 benchmark index. Now, as you all know, the S&P 500, or the SPY, I should say, made a new all-time high at March 1st at $240.32. Since then, the SPY has kind of been making little tiny lower lows here and lower highs coming down in this particular pullback configuration. When I captured the chart this morning, the SPY was trading at $235.41. That's about $23.54 on the S&P 500 itself. Now, as you can see on this screen, the red line is the 20-day simple moving average. The green line is the 50-day simple moving average. These two lines are coming together with price clasped or nested just between these two lines. Now, the 50-day moving average is a relatively important moving average to technical analysts. It's considered to be an intermediate-term trend line, and when price of any asset falls below the 50-day moving average, it is kind of we can call it a mild negative for now, as the S&P is in an uptrend, but we would always prefer it stays above the 50-day line. We had, now the 50-day line is coming in right now, if you want to know, at about $234.50, or about $23.45 on the S&P 500. So the S&P is just sitting right atop this green line on my chart, and of course it would be best if it stayed above that line. Now, we had a low at 230.61 a couple of weeks ago, so we have that pivot low to watch, and we're watching support here as well at 230 or 2300 on the S&P 500, and then down at about $225 or $22.50 on the S&P 500. We of course want price to stay above these particular support zones, but there is potential support there, meaning potential buyers should the SPY fall down in the coming week. Now we're going to be moving into, in the next week and a half, we'll be moving into earnings season, and of course with the airstrike on Syria, we'll have to see how the market takes this in all next week. Again, we are coming into earnings season, and that will have a lot of important information in it. Right now, the RSI is trading neutral at around 50. The MACD is just above the zero line, also trading in a pretty neutral stance here, but still positive. So we need to keep an eye on the SPY. If it breaks below, of course, that's a slight negative. If it manages to move higher and head back to its all-time highs, that would be great. So let's keep an eye on it in the coming week. Now, our next chart we're looking at today, again, as we usually do or many times do, especially when the market's in a in a dicey mood or a little bit cranky, I like to keep an eye on the iShares Russell 2000 ETF, as this is the small cap index that can act as a leading indicator for the broader market. So that's why I like to keep an eye on it. And we have been doing so for about the past 3 or 4 weeks. Now, the all-time closing high for the IWM, which of course is an ETF, it was at $140.36 on March 1st. Today when I captured this chart, it was at $135.49. It too has edged lower, and it too this last 2 weeks ago came down and made a pivot low of $132.40. Then it moved back up. Now it's trying to make up its mind. It's really been trading in a range here from about 132 to about 140 at its highs. It looks like it's losing some of its giddy up here, and that is a little worrisome to me. It's now trading below its 20-day and 50-day moving average. Next week, the IWM, again, which looks like it's getting kind of tired here, needs to start moving up to keep its, to at least keep in this range above 132, 133. That's what we want to see. The RSI is neutral here. The MACD is slightly below its zero line. So let's keep an eye on this support zone here at about 132.50. Should it fall below that, then the IWM could pressure the broad market lower. So let's keep an eye on it. Keep an eye on this 132.50 line, 133, and let's see if the IWM can stay above it as we move into earnings season. Our final chart for the day is one that we haven't looked at in quite a while. It's the Materials Select Sector Spider Fund. It's an ETF, symbol XLB. It has 25 holdings. Some of the top holdings are Monsanto, Praxair, PPG Industries, Sherwin-Williams, Ecolab, some great companies in this ETF. I'm watching the XLB. It recently dipped with the market to a low of 5104. It made an all-time high back here on March 1st. That's at an all-time high of $53.44. Again, it moved down to 5104, but it rallied very quickly, moved right up again, right over its 50-day and 20-day moving average. Now it's kind of looking both ways to see where it does want to go. Again, the RSI is kind of neutral, as is the MACD. I call this a low-risk trade because the XLB is trading just above its 50-day, just about above its 20-day moving average, which have come in together. When I captured it today, it was trading at $52.68. What I want to do is keep an eye on the XLB as we move into next week's trading sessions. I would like to see it move up here on stronger volume and see if it can move up, potentially up to 53 and above it. If it can do that, and of course stay above the 50-day moving average, then I would be willing to possibly get some shares of it in the coming week. However, if it rolls over and moves below the 50-day and the 20-day moving average down toward 52 and lower, then I won't be interested in it until it rallies once again. So kind of a low-risk trade here. But again, let's see what happens to it when we get into the beginning of next week. And now on to this coming week economic reports. But first, please join us this Monday, April 10th, for our next session of Tony's Market Club. We'll talk about which side of the market to trade. That's going to be important this week. Have a mini trading lesson. And I'll give you stocks and exchange-traded funds that may become ripe for high potential trades. This is a low-priced, high-value opportunity to learn more about the market, become a smarter trader, and make more money. So please join us. For those who cannot attend our live session, there's no problem. The recording of our session is available to all of our members. just a few minutes after the session ends. For more information and to join, go to tonysmarketclub.com. For economic reports next week, not much going on Monday and Tuesday. On Wednesday, we'll have crude inventories, and let's watch crude inventories. I didn't mention getting into energy stocks this week because the pattern's still a little dicey. However, we may look into them in the weeks to come. So on Wednesday, we have crude inventories, so watch those. On Thursday, we'll have jobless claims, our usual nat gas inventories, and the monthly PPI report. On Friday, we'll have the CPI, which is the Consumer Price Index, retail sales, and the Michigan Sentiment Report. Again, please join us for Tony's Market Club this coming Monday. Don't miss out on this terrific opportunity to raise your trading knowledge and your trading profits. Until next week, keep green on your screen. I'm Toni Turner, and this is the Market Now.